uh, video online. So again, I'm going to jump right into it. Not going to spend too much time about me. I think we've gotten to know each other already by now. But what we're going to talk about today is creating life event funds, taking a closer look, right? I think that life is not a constant, and there's different things for all of us. Life isn't necessarily a straight line. There's zigs and zags, and we'll talk about that. And a lot of times there can be changes that can happen throughout life. There can be planned changes and there can be unplanned changes. So we're going to talk about how do we manage our money throughout all the things life throws at us. So as we, review a couple things, we've already talked a little bit about the real cost of living, right? Not just the impact of inflation and taxes, but everything that's trying to grab our money, right? Product wear and tear, new inventions, improved standard of living. They say cars, shingles, clothing, carpets, everything that you buy must someday be replaced, most everything, right? And so there's all these different things that are coming at us that are really eating at our cost of living. So consider this image, right? Whoever created this deck, I love it because I think it's kind of silly, but also powerful. But, consider this image is that, here we are, moving through time, trying to do the best that we can to manage our finances. And as you look above, there's this amount of capital, this amount of money that you've worked hard to save or invest, but you can't access it, right? And there's a challenge when sometimes money becomes what we call illiquid. Illiquid means you typically can't access it without penalties and fees. And the reason why we talk about that is that there really are two types of life events that happen, or at least I think so. There are those life events that are planned, a wedding, buying a house, and there are those life events that are complete surprises. Sometimes they can be good surprises, sometimes they can be bad surprises. But the reality is that we can't, always plan for the future. The ones that we can plan for, college, weddings, homes, these are typical things that we save money for. You have a special college savings account or, a home buying savers account. You're putting money in every single month. And we're going to have access to that money later down the road, right? It's typically in a bank. So how do you consider planned life events if all of your money is locked up and out of reach and inaccessible, right? Allowing you to be able to respond to those events when they happen. Conversely, there's unplanned life events, right? Again, a lot of unplanned things have happened over the last year or so, but some, to talk about here, an injury where you can't work for a couple of years, a disability, Mother Nature, there can be a storm. We had flooding from the lake a couple of years ago. Stuff can happen. Parent care, loss of jobs, right? So when you throw into the mix of planned events and unplanned events, it can be challenging, and the combination of these known, highly likely planned events that are going to happen, along with the surprises in life, can really cause you to reconsider your cash flow decisions. Really, I guess, to make sure that, we all have ample levels of liquidity. A lot of times people who may think they're a great saver, and that certainly is true, but if we're not saving in the right places, that bird cage above can cause us to have challenges when we try to access that money. And so words matter. Let's define it. Liquidity, it's an adjective, right? Money that can be easily accessed and converted to cash without significant fees, penalties, taxes, or delay. So, when we look at, I'll go back there. When we look at the different places that we can save our money, it's about having balance on your balance sheet. Traditionally, people typically have taught us, or my industry's typically taught people to, go to college, get a job, put all your money in the 401k and buy a house. Now, those two things are great, but you can't easily access that money. So want to look at some statistics. This was as of January of 2020. Don't have anything new yet, but nearly 4 in 10 Americans, about 37%, would borrow money in some capacity if they were hit with an unexpected bill. Additionally, multiple surveys have cited the fact that Americans struggle to come up with just $1,000 to respond to an unexpected life event, where most people would end up going back into debt because they didn't have anything saved for the unexpected. I think that people are vulnerable and have been, and they have to turn to what I would call inferior sources of capital to get by, right? High interest debt, or maybe making sacrifices that they wouldn't or hadn't planned on. So what do typically Americans do? Talk about the problem before we talk about the solution. So when life events happen, typically people have turned to their credit cards, right? Credit card indebtedness is at an all-time high. It's probably the first place that people go to when there's not enough liquidity. They just charge things and hope to figure it out at a later time. There's also some things we can talk about a little bit about how to properly use credit cards, but that's where people turn to most. As of September 2020, so not too long ago, credit card balances in America was almost $1 trillion. And an overwhelming majority of the credit cards have higher interest rates, right? There are certain ways that you can play the game. I think I mentioned last week, you can always call your credit card company and ask for a lower interest rate. That's something many people don't realize that you can do. And we'll talk about how to refinance it. Another place that people run to for money when the unexpected happens is something called home equity, right? So, if you own a home, or one day when you plan to own a home, your home increases in value, and you can technically go to the bank and say, hey, I want to take a loan out against my house. It's usually at a very, very cheap interest rate, and it's not always a bad idea, but it really shouldn't be the first place that we go to when something unexpected happens. As of 2020, $375 billion of home equity debt was outstanding from Americans. So it's something that people use. Other life event sources, student loans, right? Perhaps when it isn't enough, savings isn't enough, student loans have been utilized far too often by people as a means to help educate their children, right? Maybe people didn't plan ahead, or maybe life just took you in a different circumstance. And so when we look at student loans, I don't think anyone's going to be surprised to see that that's the highest of the three, right? Student loan debt as of mid 2020 was over $1.5 trillion. So it's really a huge cash flow drain that exists. That's why I like talking to colleges and talking to young professionals, because I still have student debt. I had to take out loans. And it's really about managing that debt in a professional and thoughtful way. I don't double or triple pay my student loans just to get rid of it. I typically pay the minimums while I'm building up my cash flow reserves to pay for life events, both planned and unplanned. And the other option to talk about is a 401k loan. So as you guys are starting to enter the workforce, maybe flash forward, 10, 15 years down the road, if a life event happens, many people are taught right off the bat to enroll and max out their 401k plan. And there really are tremendous benefits with retirement programs, but there are some challenges to taking money out early. There's lots of taxes and lots of fees tied to it. Looking at this, as of 2018, there was an estimated $7.3 billion in loan defaults. That basically means loans that people couldn't pay back. So, when you have a 401k and you take money out early, before the age 59 and a half, you're paying interest rates on it, you're paying taxes on it, and you're also paying early withdrawal fees. So when we look at these four areas that people turn to, my goal is to help educate people to do everything we can not to turn to those four. And that's really what it comes into from a savings standpoint. So let's look at a time horizon, right? If you look at just where you are today and where you think you might want to go into the future, I want to give you the image that my industry, the traditional industry, typically, says. They look at things from a very linear path. I disagree with that. And I think if you look at it from a linear path, here's the problem. If you just look at it, from a pragmatic approach, there's standard life events, right? The big three: go to college, you get married, maybe throw a house in there, and retire, right? Those are the big three things that happen to most of us. And based on this timeline here, the last thing you'd be doing is storing money for retirement, because that comes last. right? That's kind of the challenge. But what happens? Unplanned event, right? Maybe causes you to delay when you can enroll into college. Maybe you got to work a little more. Maybe after college, you have to take care of a parent and you can't buy a house in time. Maybe puts off that wedding. Maybe afterwards you now have kids and something unexpected happens. So there's all these things that really eat at our income potential. And I would say that life doesn't look like this. It's not a straight line. Typically, traditional financial planners look at it this way, and that's why I think the industry is old and outdated. I would say that life looks like this. Mine does. I don't know what part of the squiggly line I'm at now. It's really filled with sudden turns, and there's a lot of unexpected and expected occurrences that you guys will face throughout your lifetime that will require ample levels of liquidity. Again, liquidity meaning access to your money. So, step 3 is very important. It's a very important, critical element to achieve financial balance because it shows you where your savings should go. It shouldn't all go to your retirement account. It shouldn't all go to the bank. So if you think about it, let's look at this a little more deeply. If you're saving money and maybe getting a rate of return of 8%, but you have 18% of debt, you're -10, right? So I like to just share this image a couple times because we sometimes develop a false sense of security. We think we're saving, or we look at our retirement account and it's up and we're like, oh man, we're doing great. But on the back end, we're getting crushed with debt. So what do typically people do? They sacrifice their savings to go pay off that debt. And it's just this rabbit. It's a hamster wheel, rather, of just never kind of getting ahead. And so, again, we could talk about so many different challenges, but I want to keep it relevant. And so from a student loan perspective, where most of us either have student loans or we probably all do, or some form of them, we know that student loans are about $1.5 trillion of debt between public and private loans. And I think it speaks highly really to the failure of college funding. There's a whole argument we can be made of how it's outpriced, how it's overly priced. And when we think about strategy, it's about where do we put our money, right? And so there's different types of student loans that are out there, different types of savings plans. But really what we want to talk about is how do we have our money accessible so that we can balance when we pay it off without having these types of risks, without having these types of fees, and without sacrificing investment returns. So we'll talk about these. Again, just to touch on a couple other challenges before we kind of switch gears here. As you plan on entering the workforce and maybe buying a home, a lot of people don't realize that you can use your home as an asset, right? And so a home equity line of credit is something that a lot of homeowners use to pay down debt, to free up cash flow, but there are some challenges with it, right? You must qualify. Not everyone can get it. There are credit limits. There's only so much that you can get. Interest rates can change. So, there's always a pro and con to everything. But when you think about what's preventing us from having liquidity, this can be part of it, right? There can be problems. The value of your home can fluctuate. It can put you on timetables when you can withdraw your money. So again, if you think about the problems, the planned life events, a home is one of them. And we want to only use these resources as like a last resort, right? We want to have the cash on hand. So yes, you can use your home equity. Yes, you can use 401k loans, but we don't want that to be the first place. So my goal here is really just to kind of talk about the pros and cons from an education standpoint, because typically people would say, yeah, if you've built up a 401k plan, you can take money out. Well, problem is, again, there's interest rate. You can only take out 50% of it. You got to pay it back within 5 years, dangers of defaulting. So it's not really an optimal plan. And that's really what I'm trying to do, is just kind of kick the traditional mindset. And so despite these drawbacks, employees typically use 401k loans as a common source to respond to a life event. 20% of people have an outstanding 401k loan at any given time. So that to me tells me that they haven't properly saved in the right places, right? Because they are accessing their money in the wrong places. So as you think about it, again, this is rhetorical, as young professionals, as we're starting to build our balance sheet, let's think about, hey, do I want to have a little bit of my money liquid or a lot of it, right? And typically this is what most people have. And we want to change that mindset, right? We want to plan for the expected and unexpected life events. So we did this exercise, I think, a couple weeks ago, but I think it's interesting to kind of do it again. And just again, we talked about 401k, cash value life insurance. Again, is the type of life insurance that you can access the death benefit early, so you don't have to die to access it. Real estate equity, bank accounts, mutual funds. These are 5 really key categories of places that people can access money. So as you're kind of thinking it through, just think about what would be the most liquid of these 5 and what would be the least liquid. Now, we don't have to go through all of them, but as you're kind of thinking that through, let's take a look at what the most and least liquid would be, then we'll fill in the gaps and talk about it. Bank accounts, obviously, right? That's the most liquid. It's easy to put your money in, easy to get your money out, but you don't really have a great interest rate. Real estate equity is really hard to get your money out because you have to find a buyer and it takes lots of time. And then everything in the middle, cash value, life insurance, mutual funds, 401k, you can access those money. Some of them have fees like 401ks, and some of them don't, like mutual funds and cash value life insurance. So really, when we talk about balance, it's about having a little bit in each of these buckets. And so what does optimal look like? We want to be solution focused, right? And so I would say a goal for all of us here and all of us that are listening is to get to the point, and again, this may take some time, right? I'm not, there yet, right? I mean, it takes time to get there. But we want to have 75 to 100% of your annual income liquid. That's basically like 9 to 12 months. I think in the past, people would say just 3 months was good enough, but COVID taught us that that's not enough. So, if you make $40,000 a year or $100,000 a year, it's really getting to the point where we're having most of the income set aside in a liquid account. And again, that may take time, but this is step 3. So we're assuming that we've already addressed protection, step 1, and we're already become an optimal saver, which is 15 to 20% of our income. So, I think this question is nice to ask. It says, how would you feel if you had 1 year of earnings in your checking account? Like whatever that salary number is, I know I'd feel great. I'd feel more confident. I really wouldn't care that I'm only getting 0.02%. It's not about the interest at that point. It's more about knowing that I have access to my money. What kind of decisions would you make? Right? How would that affect your financial confidence? How would that affect, what you would be planning on doing this year? So I think, that is self-explanatory that that's the goal. And really to kind of bring some clarity to it, here are your choices, right? This is what it looks like from a balance standpoint, visually, right? We have these 3 buckets: bank accounts, easy to get; investments, which is basically anything tied to the stock market; then cash value life insurance, which is again liquid money, but it's not tied to the stock market, right? So they kind of balance each other out. All 3 of these are important. How do we balance it? So I kind of like this triangle a little bit better. The pyramid, I think, breaks it down and puts it into perspective and really look at that. It's not just $1 in every category. It's really not just, even between all 3, right? In an optimal world, you'd have money in the bank, but maybe only 15 to 20% of your liquid capital in the bank. The rest would be deployed to investments for the future and cash value life insurance to protect those investments because they work hand in hand. Typically, when we work with clients, these type of strategies can take 2, 3, 5 but ultimately it's about giving people control, right? If we have control on where we put our money, right, it really leads to financial stability and financial confidence. Otherwise, people typically are just putting money in the bank accounts, in the investments, and hoping that it'll work out. So we'll talk next week too about how do we take control of our cash flow and how do we tell our money where to go instead of asking where it went. Because I think you have to be in control if you're going to put yourself in the best possible position to really respond when life, changes its mind, right? You can be going down one path and you get a curveball. We've all been there. So having this picture in mind, or in your mind, with this triangle, just gives you some concepts about how important it is to have immediate access to cash in the bank, that's supported by investments, that's supported by cash value life insurance, right? So it's really having a combination of those three. So liquid capital features. Right now, let's look at some of the features of these three and see why they make sense in that triangle. So from an education standpoint, I know we're going through a little quick, but I want to actually just make sure we touch on this because we have a lot to cover. But from an education standpoint, let's look at the features just from a standpoint of liquidity, access to your money, rate of return, and tax strategies, right? Because those are three things that may not sound fun, but we have to talk about them. Liquid, bank accounts, insurance, cash value, investments, they're all liquid. In one form or another, you can go to the bank, you can pull money out of your cash value policy, you can take money out of your investment. So we like that. Rate of return. The banks are paying 0.001%. There's no real rate of return at the banks, and that's okay. It serves a different purpose. Cash value life insurance and investments historically have really good rate of returns. From a tax standpoint, your bank account interest is only taxable if you earn more than $10 of interest. Cash value money is not taxable. You can take that money out whatever you want. And investments are taxable. So just for education, if you buy and sell an investment for a gain within less than a year, you have to pay a short-term tax rate, which is high. If you hold it for longer than a year, you pay a long-term tax rate, and that's a little bit lower. So there are tax implications to the bank accounts and investments when you sell. But the insurance cash value one, there are no tax implications, tax-free. Lastly, from a risk standpoint, right? Money in the bank is safe. It's federally insured. Money in the stock market could go down, could disappear. It could go up, could go down. It's all over the place. The cash value doesn't have risk because there are guarantees in there. So when we talk about balance, I think this little chart just shows why it's so important to work for all three of these on your balance sheet. And really, what are the benefits of optimal liquidity? Lower insurance costs, right? Think about this. If you have enough cash on hand, you can go to your car insurance person and say, I'll pay higher deductibles if something happens. That means your monthly insurance bill is going to go down, right? So that's a positive. Another thing about car stuff, I also heard talking to a property and casualty friend of mine, he said, most times when there's an accident, it's almost cheaper to pay out of pocket than filing a claim. The only time to really file a claim is if your car is completely totaled. So there's a lot of nuances in the car industry. Avoiding punitive loans are basically, nasty interest rates, right? If you have money on hand, you can avoid those high interest rates. You can have increased control. The more you can stay in control with your life, I think the better ability you have to respond. Lower taxes, right? Certainly taxes will be lower if you're liquid and you've taken advantage of the tax advantage products that exist. People often think, or have misunderstanding about the tax code. The tax code was really put into place to help us save money and pay less taxes. That's the real root of the tax code, because there's all these exceptions and deductions and credits that exist. And lastly, and most importantly, having optimal liquidity, which again is about 75% of your annual income, accessible, bank account, cash value, life insurance, and investments. Having that liquid gives you that financial confidence. So, I like to just kind of finish up this part of the presentation to talk about kind of what it looks like from a teeter-totter standpoint. 401k and real estate is the fun stuff you hear on the news or social media. You hear about real estate, investments, and actually hearing more about, crypto and stuff these days. That's not on the chart, but really 401ks and real estates are great, but if you're too imbalanced and all of your money is in the 401k or in the real estate, you're at a deficit from a liquidity standpoint. So just keep that in mind. It really should be about even from a total asset dollar amount. And here's what it can look like, right? Hypothetically, if you're protected and if you become a world-class saver, right? So typically cash flow comes in and people are pouring money into their home, pouring money into their 401k, pouring money into their debt, and it leaves very little money for savings. But if we've become a world-class saver, we've put the money towards protection, now we're saving in the right places, right? We're pumping money into liquid accounts, which is money on the left. And then we're making minimum payments on our home. We're not double or triple paying it. We're only putting in the match to our 401k, right? So if your company, if your company offers a 401k plan and they say 4% is the match, don't put 10% in there. I mean, typically it wouldn't make sense. Every case is unique, but typically it wouldn't, because the 4% is all you need to get the match. Let's think about where else can you put that other 6% so you have access to that money before you're 59 and a half or whatever they raise it to. So from an action item standpoint, right, we want to protect our todays, because none of this matters if we're not protected from an insurance standpoint. We want to become world-class savers where we're saving 15 to 20% of our income. We know that can take some time. Next week, we'll talk about saving strategies from like a bank account budgeting standpoint, and really deploying that annual savings to achieve that balance. So I'd say like a benchmark goal would be to, as we enter the workforce, as we're growing our balance sheet, is to have 50% of our assets liquid and 50% not liquid, which is into the bank accounts, into the 401k. So those, are really the key action items from a liquidity standpoint. And so I'm going to just switch decks here. If you have any questions on anything liquidity related, let me know while I just switch decks real quick. All right, so that's me again. Couldn't figure out a way to break them up, so you're going to see me twice. So, living debt free. This one is where we get the most, I think, questions on, and it's sometimes the most painful, because debt is something that really is challenging. And we're going to talk about the two different kinds of debt, talk about what are some tips and tricks we can do to get out of it. But remember, step 4 is step 4 for a reason, right? So we've put money towards protection. We've become a world-class saver. We're saving in the right places. And now we can tackle debt. So let's, again, talk about what we typically like to say is the allure of debt, right? Debt isn't necessarily a word that any of us want to attach ourselves to or tie it to our balance sheet. I think oftentimes it happens in an instant, before you even know it. I mean, I know even personally for me, there have been times where you blink and your credit card has gone off more than you realized. And I think there's a couple of reasons behind that. But, as we move through life, we lose this ability to disassociate from it. So like, think about it this way. Actual money, as in physical cash in your pocket, feels different than things that symbolize money, right? I don't know if anyone's ever been to a casino before, but when you go to a casino, you have to give your money and they give you chips. It's a lot easier to lose 10 chips instead of losing $100 if each chip is worth 10, right? So when you think about how money is perceived, there are some really interesting thoughts behind that, right? What if you use cash instead of poker chips at the casino, right? The casinos know that chips feel different from cash, right? It feels, it feels almost less real, right? That's why that they use chips for card games. That's why when you go to a slot machine, it's converted into credits and vouchers. I think there's an analogy here, right? The question is, are you likely to spend more using credit than if you use cash? I know typically for me, if it's just numbers on a screen or just on a plastic, it's a little bit harder than if I have cash in my wallet. If I know I have $40 to spend that week, if I'm carrying 40 cash versus my credit card, there's a difference, right? Until we learn kind of budgeting and cash flow habits. Sometimes if we use credit card too much, we often buy a little more, we splurge a little more. You go to Tim Hortons, Taco Bell, $8 here, $9 here, $6 here, and before you know it, that money adds up. So I always like to pose this question in the short time that we have is, how would your spending change if every transaction was made by using cash? And we'll talk more about that next week. Cash isn't always practical, but there is a way to make it practical. So what is this step all about? Step 4. We want to recognize that debt is overwhelming. It's a big problem, but there are solutions to manage it. So we talked about how vital it is to be a world-class saver, establish those savings habits. You're saving 10, 15, 20%. You're putting money in the right places, but there are often many things that get in the way of saving regularly at all. That's really the main contributor. It's these roadblocks that we talked about, I think a week or two ago. Making these debt payments create a barrier to financial independence. There are these roadblocks that stand in the way from becoming a world-class saver, because if you have to keep paying money to the car people, keep paying money to the mortgage or the credit cards, money doesn't really stick with you. Having too big of a house payment, it takes up, a big chunk of your balance sheet. Every year buying a new, every 2 years buying a new car. Mismanaging short-term debt like student loans or credit card bills. These all have implications on your long-term future. So the presence of debt, again, is a roadblock to reaching world-class savings. It's a big roadblock. We teach people a very important rule when we go through the wealth steps, when we work with them. It's that your house payment should only be so big, and that your short-term payments should be eliminated permanently, allowing you to focus on saving properly. Right? That's the goal. So if we look at debt, right, let's start out with the definition like we did with liquidity before. Our definition around debt in general is that you couldn't afford something, a car, a new phone, a house, but you bought it anyway. If you could afford it, it wouldn't really be debt because you'd have the savings and cash for it. You bought it anyway, you used the car loan, you used a credit card, you used the big mortgage. When you did this, you committed a part of your paycheck that you haven't even seen or earned yet to paying off that loan over time. Right? Agree? Disagree? That's what it would be. So there really are different types of debt. That's another thing that is important to understand. And to really fully comprehend how to best handle your current debt, because obviously we're not talking about specifics, but generally speaking, let's talk about these different types of debt. So the first one is short-term debt. Think credit cards, auto loans, student loans, home equity line of credit. Inside this category, there are two types, what's called secured debt and unsecured debt. So secured debt is going to be an auto loan or your home equity line of credit, meaning in theory, if you don't pay for it, they can come repo that car. They could technically put a lien on the house. Unsecured debt are credit cards and student loans, meaning it's not backed by anything, which in turn makes the interest rates higher. So when you look at the credit card and student loan interest rates, they're almost always going to be higher than an auto loan or home equity, obviously depending on credit and some other factors. So when you think about tips on how to get out of short-term debt, And one of the things that I encourage everyone is just have awareness around your current credit situation. Your credit score is not written in ink or stone. I mean, it can change over time. It may seem deflating, but making on-time payments are the biggest thing, even if they're small payments on a payment plan. You can get your free credit score from annualcreditreport.com. It's from the federal government. You can get your free report from each bureau once a year. There's 4 main bureaus. So in January, get your report from TransUnion. In April, get it from Experian. Next one, get it from Equifax. So if you get your report, and not just the score that Credit Karma gives you, but your full report, you can see if there's any challenges or mistakes on there. Consolidating debt, working with a financial professional, working with the bank to take 2 or 3 credit cards and combine it into one low personal loan. So those are some tips on how to really tackle short-term debt. It may feel uncomfortable, but really having that awareness around what your interest rates are is step one. The other type is mortgages, long-term, right? On the other end of the spectrum, you have long-term debt. And part of the problem with mortgages is what I call this crowding out effect that has a pretty big problem on home buying decisions tied to wealth. So short-term debt, again, the presence of a credit card month after month, the interest is attached to those balances an obstacle. Higher interest rates, like we talked about, limited payoff period can hurt your cash flow. Mortgages, maybe the appreciation, the value can go up a little bit. Liquidity is a challenge. There's other costs to the house. I bought my first home almost 3 years ago, and every year there's a project. So there are other expenses tied to the debt than just the debt themselves, right? It's not just a bill you're paying the company, it's other things that are tied to it. So let's look at a couple case studies, right? Real quick, credit cards, auto loans, and mortgages. And I think we want to look at these just really quick to talk about how they can have an impact on your life. So I'm not going to spend too much time. Obviously, this is recorded. You can, take time to read all the numbers. But generally speaking, this case study is looking at someone with 2 loans. A credit card that they're paying $450 a month on, and a student loan they're paying $650 per month. The total of these 2 payments is $1,100, or about $1,300 a year. And oftentimes, this amount of cash flow feels like a bucket that's about to overflow. It's too much debt. The high payment may be crowding out the ability to protect your todays. You can't put enough protection or savings in place. So plan 2 is a little different, right? Imagine if you were able to take that overflowing bucket of debt and pour it into a bigger container, like a bathtub, right? To make it more manageable, to prevent the debt from spilling over. Perhaps maybe by making minimum credit card payments, right? So I'm gonna go back. Credit card payments go from $450 to $250, and your student loan payments go from $650 to $300, right? If we're making minimum payments on the credit card, refinancing debt into lower interest rates, or taking your time on the student loans by stretching them out. A lot of times conventional or traditional wisdom would say, you got to pay off your student loans in 5 years. At what cost? That's going to leave you with 0 money in the savings account. I'd rather pay my loans off in maybe 10 years, have more time to pay it off with lower monthly payments so I can build up cash. And then, hey, if I've done a great job saving, nothing's stopping me from making a one-time payment at the end of the year. So in this hypothetical scenario, they're saving 50% of their payments because they've refinanced and stretched it out. So the way that debt works is that if you make a longer payment time, you typically get lower monthly payments. People will say, yeah, well, you're going to pay more interest over time, but that all depends on what you do with the savings, right? What if your interest is 4%, but you can get 7% elsewhere, or you're just building cash on your balance sheet? So realistically, if you saved up the difference each month from these 2 scenarios, the difference would be almost $92,000 of savings or investments in just 10 years. Now, I understand that, it may not be always easy to refinance your debt, but I would definitely encourage people to think twice before double or triple paying their loans if step 1, 2, and 3 haven't been addressed. Again, we talked about this, the challenge of building wealth, but also short-term debt. And everything that we surround ourselves in our home, in our life, is going to go down in value. You drive a car off the lot, immediately it's worth less. I have a Moto Z2 or some kind of, my phone here, I'm sure I'm 2 models already behind. I got it last year. So there's always different ways of technology. There's always different assets that we own that are decreasing in value that cause us to think about upgrading, right? It ties back into debt. Things like wear and tear, carpets, shingles, car tires, appliances, furniture, clothing, they haven't been designed for a lifetime. Now, I'm not going to need one roof for my whole entire life, right? There are things that are going to come up that we have to take money off our balance sheet. And if we didn't save for them, that's when we get into debt. When you buy those new things that didn't exist in the past, those same saving dollars that could have been growing on your balance sheet are now going to the new technology, the new inventions. I'm not saying don't have fun and don't enjoy life, but again, what was that definition of debt? Buying something you can't afford. So let's save for it. Car ownership is one of the biggest obstacles to wealth accumulation. We live in America. We don't have a great public transportation system, not in Rochester at least. So you need a car. But just to have an awareness of the difference between new cars and used cars. And for the sake of time, just quickly going through this one, is that, having used cars with lower interest rates, right, can save you a significant amount of money over time. Typically, a new car on a new lease is, 3 to 5 years. If you're getting a new car every 3 to 5 years, that's money that isn't really A, growing, but B, you're not really building a value because one time you will own that used car. Conversely, let's say you saved a bunch of money and you can go buy that car with cash. That's good too, but that takes time. So some debt myths I want to just kind of address here in our time. Traditionally, people will say a 15-year mortgage is better than a 30-year. Why? Well, because you're debt-free. You own the house in 15 years. Well, let's disprove that. You buy a home worth $300,000, 4% interest rate, right? So over 15 years, the annual payments, $26,600. But after 15 years, you own the house. And this is where the time value of money comes in. The time value of money is a concept. It doesn't get taught, but it's basically saying, if I'm comparing 2 options, right? We're looking at the lost opportunity cost, the lost value that money could have grown. And that's really demonstrated by this mortgage example. So the second person who has that 30-year mortgage, right? So 15 years have gone by. Their annual payments are lower, but yes, they still owe money on their house. However, they were able to keep about $9,400 a year on their balance sheet. Why? Because they weren't paying it to the bank. So if they were able to keep that money and invest it, and let's just say get 5%, 15 years in, they'd have about $234,000. So in theory, they could take their savings and pay off the house if they wanted to. But think about that. Which of those 2 people would you like to be, right? The person that has the 15-year mortgage where your house is paid off, right? But there's no savings. Your savings took a hit. Or the second person is where, yes, you still owe money on your house, but you have savings that are liquid. So, we'll talk about next week about cash flow. I think cash flow is so important. And really what most people do is something like this. You make money, it goes to your lifestyle, it goes to your home. People are pouring up to 35% of what they make into a mortgage payment. Then it goes into debt, credit cards, car loans, personal loans. Then they try to save whatever's left over. There's a common thought that there's always a next paycheck to put towards savings, or next time I'll add more. But what people often will think about is, what if there is no next time? What if there is no next paycheck? And then they start to look at protection, right? The common traditional way of thinking is that people will scrap together what they can to put towards protection. And one of the things that I always struggle with sometimes is, if something bad happens to people, whether it's a death or disability, you see the GoFundMe's go up, right? And I always think to myself, had those people had the right steps before, put the right insurance or protection, whether it's life insurance, homeowners insurance, disability insurance, whatever it is, they wouldn't have to be depending on strangers for a GoFundMe, right? And so, I think that is what most people do. Conversely, what we really recommend from the Wealth Steps perspective is, again, protection first. We've talked about it, a couple times 2 weeks ago or last week. Savings. Talked about building up the habits. And next week, again, is going to be about how do we specifically budget for it. Automatically having a chunk of your paycheck go to a separate savings account. There's two types of savings. There's short-term and long-term. So splitting that up and having money liquid, having it accessible. Then using the extra money to pay down extra debt, right? Having it refinanced and not double or triple paying our debt. And then lifestyle. Not saying don't have fun, but if you do it in this order, you can have fun that's stress-free, right? And you're not feeling guilty about it. I know I'd rather spend $1,000 on a vacation where I have the cash that I saved, $40 a month for a year for, instead of, or $80 a month for a year for, instead of using on a credit card and stressing out afterwards. It doesn't have to be said, right? Debt is destructive. I think it's crippling. And I think that there's a lot of piranhas out there that are using it to play off people's emotions, right? Debt can destroy hopes and dreams. It can, ruin relationships. You've probably all heard stories about, a husband getting into debt, jeopardizing the relationship, increasing stress, lowering your ability to save, reducing your protection, not putting money towards life insurance or not enough car insurance because, hey, you can't afford it because you got to pay Visa, or not getting in because you got to put all your money towards the loan. Your saving account suffers, and it can lead, really down a path into more debt. You don't have any money accessible. So, if debt is so bad, and this is what a lot of people ask, why is it step number 4? Like, why wouldn't it be the first thing that you do? Like, shouldn't you be racing to pay off debt, even if it's high cost interest, and leave yourself, maybe leave yourself exposed? You should be saving today instead of saving for years from now. So I think this next, kind of example puts it into perspective for me, why it's step 4. Because step 1 through 3 is about you and your family. It's about my family, my wife and my almost 10-month-old daughter and my 2 dogs. It's about me and my family. Right? I want to make sure they're protected. If I get disabled and can't work, if I get into a car accident, if I get sued, if I pass away, I want to make sure that we have enough savings put aside for the future. Make sure that savings is accessible. It's step 4 because step 4 is really about the banks. So in my opinion, I would rather have my assets and my plan benefiting me first before the banks. And again, does that mean I'm endorsing you default on your debt and don't pay it? Of course not. But there's a way to do it where you're not putting 100% of your energy towards living debt-free towards the banks and leaving yourself exposed. So that's what I think is why it's on step 4 and why, I kind of agree with the philosophy. And to kind of, close here, we talked again about that. We talked about prior about this crowding out effect. And I think it really gets in the way of financial balance. And what is that crowding out effect? If you're paying 30% of your bills into mortgage, What is that doing? 30% into your mortgage, 50% into your debt. 45% of this person's money is going towards other people, not towards your own balance sheet. Taxes are taxes. You can't really change them. But conversely, if we're living kind of within our means, we have a proper mortgage. And this is the most common one for young professionals because the home buying market is hot, and maybe it's unpopular, but maybe it's okay to live at home for a couple extra years or to rent while you're building up your savings. Historically, people said you go to college, you get a house, you get married. Like, I think that doesn't exist anymore. It shouldn't. We all shouldn't fit into just this cookie cutter mold. Everyone is unique, and living within kind of your means avoids that crowding out effect. So, kind of in conclusion, from a debt standpoint, what are some action items? Follow the hierarchy. Protection first. Building up your savings. Saving in the right places, then paying down debt. Slow down, meaning you don't have to, double or triple pay your debt. Living within your means, right? Having a mortgage be 15% of your salary or less, or wait until you have enough, to put down, or wait until you have enough to absorb that cost. Try to have your credit card balance zero every month, right? That may take some time, but the goal should be, if you're going to spend $600 a month on credit cards, you should have $600 a month kind of budgeted for it. And that's what we're going to talk about really in detail next week. Yes, we all want a brand new car. Maybe you drive a used car for 3 years until you get your savings built up. Raising insurance deductibles. The theory is if you raise your deductible, it lowers your monthly cost. Talk to an insurance professional. Trying to use cash, paying attention, improving savings, right? It really protects us against a lot of these other challenges, right? The Jones effect, right? You got to buy the new toys, keep up with the neighbors. People have the pressures of advertising that are out there. Rate of return bailout. That basically means I don't need to save. I'll be fine. As long as my investments keep doing 10% like they've been doing the last couple of years, I'll be good. Spoiler alert, that's not always the case, right? The market goes up and down over time. Procrastination, having money less liquid. So, those are just some specific kind of action steps. I guess, in closing, what I would encourage everyone from a debt standpoint is just recognize that, you can do it. Your credit score isn't finalized, right? It's not there forever. Make small changes. Talk with a financial professional. There's some really great, debt management people out there. There's a lot of work that I do with clients, but keep in perspective the steps, because the last thing we want to see is people overcommitting to debt or saving in the wrong places. And then that squiggly line of life happens, and you go back into debt, and it's just like this treadmill. So we're right at the hour mark. A lot of stuff, so I appreciate everyone listening now and recording, just being patient if it went a little quick, but I wanted to cram it all in so we can do our fun exercise next week. So I don't know if there's any other questions. Otherwise, that's all I have, and that concludes the 4 steps from a wealth step standpoint.
Thanks, Frank. That was great, as always. Maria, did you have any questions that you wanted to ask Frank now, as it relates to what was conveyed today or previous sessions? This is your time to do so. So I'll give you either a minute, either you can mute yourself, or if you have anything to say in the chat, you could also write it as well. All right, no questions. Fair enough. So catch Frank again next week, Tuesday, same time, same Zoom link. And we will finish off the series next week, which I can't believe that happened so quickly. So thank you so much, Frank, for the time and for your expertise. And we look forward to seeing you next week.
Cool. Thanks, guys. We'll see you.
All right. Have a good one.